All right, everyone, welcome back to another weekly roundup edition of On the Margin. Today, I am joined, as always, by my persuasive co-host, Mr. Mark Yusko. Mark, welcome.
Wow, no, thank you, Michael. And not apologies, but new background today, and I'm actually surprised we haven't seen this background more this summer. But we have not gotten to the beach much this summer, so we're down at the beach in Topsail Beach. Very boring place, I say. It's like going to 1950. You cross the bridge, and it's like, blood pressure goes down. It's like Mayberry RFD, and very excited to be here. Unfortunately, because you're at the beach, it's no sock day, and I actually didn't grab any socks in my bag when I left. If I had socks, they would be the Bitcoin bull, because the bull is back, and we'll talk about it. And I'm actually super excited that there's the potential for a big sock reveal, sock day coming up for our 1-year anniversary. But I won't spoil that too much.
We won't spoil it, but we do have some fun stuff in line for the viewers here. I was very choosy with the adjective persuasive this morning, because thanks to everyone that listened to the roundup yesterday, we are in the lead with Mike 250 for Digital Asset Summit. In case y'all didn't tune in for last week's roundup, we've got DAS in September 13th and 14th. Mark speaking there. We got a whole big lineup of macro names, crypto names. Y'all got to go. But most importantly, if you go, use code Mike250, because I'm in a competition with Jason. Jack just entered the running as well. There is a dinner in line. Kate needs a good dinner. Please do it for Kate, folks.
I mean, do it for Kate, and do it for us. Do it for the greatest show
for us
in the Blockworks, hemisphere ecosystem. And he who shall not be named does not deserve any codes. It's all Mike 250. All Mike 250.
Exactly.
And
correct.
Come join us. Look, you got to be there. I mean, this is big. This is going to be a big show. DAS is always great, but Digital Asset Summit. But this is going to be super big. It's going to, so be there, Mike 250.
It's coming at a critical time, because you and I are going to get to this later. But I think just in terms of institutional news, regulatory type news, two of the biggest stories that in the past year, right, have come out this last week, right? So you and I talked a little bit about BlackRock and their partnership with Coinbase. Now they had their own announcement this week where they're rolling out Bitcoin exposure to their clients. So that's a big story we're going to cover. And then we're going to cover these Treasury sanctions, right? So the US Treasury came out is sanctioning Tornado Cash. That's a huge deal. And we can explain, we're going to get into it and explain why. But first, we're going to start off with some of our macro stories for the week. We're going to talk about declining PPI and overall economic activity here. So, surprise decline in PPI month over month, right? We got to talk about the headline inflation as well, but PPI is in a
Michael, but not a surprise.
Not if you've been listening to this show.
This show. So, not a surprise. And get ready for more. Just get ready for more. This is the the whole argument and the whole debate about is inflation transitory or not. Yes, the bulk of inflation that people are talking about was two things, right? It was oil prices and used car prices, and really, yes, that was real, but the big thing was it's currency devaluation. What happened over the past 2 years is the Fed created half, which is amazing, half of all the dollars in 248 years of the Republic. And that is, filtering its way down into higher prices for everything. But it's not higher prices in the sense of more demand. It's higher prices in the dollar you had is now worth 50 cents. And so you got to spend $2 to get $1. And that's what we're seeing. So not surprising to me that as economic growth collapses everywhere, because this whole nonsense about nationalism and deglobalization, which is one of the most insane things, but it's not new, right? We've had these 90-year cycles of, okay, let's globalize, let's take Adam Smith's advice and let's do comparative advantage, and you grow wheat and I'll grow corn and we'll trade, to, oh no, we'll do all of it ourselves. Doesn't work. Doesn't work. as well. I mean, you can survive, but it doesn't work as well.
Yeah. Well, and just to back up what you're saying here, right? We saw this, so the decline in let's say in PPI, right, was largely driven by this collapse in consumer energy, right? So that's the price of gasoline, basically wholesale gasoline. So the data backs up what you're saying there too. I'd be curious, honestly, maybe if we can just start this week off with a bit of a history lesson. Can you just describe that Adam Smith comparative advantage idea that you were describing? And then how does that kind of apply to what we've done with globalization? How do you see it unwinding?
Yeah, I mean, look, the basic idea is you have a society, right, or a civilization. It's very localized. And so what do you got to do? Well, you got to grow food, and then you got to build shelter, and then you got to, find ways to create commerce, and then you might start, making some clothes to wear instead of just animal skins, and eventually you have a modern society. Well, turns out, if that society happens to be where, let's say, where the original Vikings were roaming around the British Isles, turns out that weather there is not really good for growing certain crops. Can't grow wheat very well. Can't grow citrus very well. So you'd like to have some of that, and you get on your ship, and someone says, "Hey, these Spaniards have some citrus," and hey, these people in Eastern Europe have this wheat stuff. So let's trade. Let's do some trade. And comparative advantage just says every geographic location is going to have some comparative advantage, either from resources or protected, area where no one can come steal their stuff, or routes of trade. And so if you're good at growing sheep in the British Isles, you make sweaters, and then you trade them with people who are really good at growing wheat, and you have a better life for everybody, because the people in the South get sweaters, and not that they really need sweaters, I guess. And the people in the North wouldn't want to wear a sweater in Spain or Portugal most of the time, but sometimes. So it's just this idea that every place has something that they're good at, and every person and every part of a community and a civilization has something they're good at, and let everybody do what they're good at instead of trying to do what they're not good at. Don't try to grow grapes in places where you should grow oranges. Let people grow grapes, and then trade. And for years, the world tried to globalize, right? For thousands of years, people tried to globalize. Went from nomadic tribes to then having transportation, and then you had things like the British Empire, where the sun never set, and now colonization. There's a little bit of bad stuff around that. But at the end, what we learned is that Adam Smith was right, and that we needed to have this global trade. And the other thing about it is, it also, leading it all back to Bitcoin and the orange shirt, right, is it had to do with units of trade, right? That's where money came from. In the old days, you would have a farm, and you had chickens, and I had a farm, and I had cows, and we would bring physically those cows and chickens to the market, and we would trade. We would barter. And they were like, geez, it's really a hassle to get those chickens to come to the market. So why don't I print little coins with chickens on them? And Mark will print little coins with cows on them, and we'll come to the market and we'll trade our coins. And then I'll have a claim on 3 chickens, and you'll have a claim on 2 cows. And if that was the exchange rate. And then we got these big old sacks of coins. And it's like, geez, carrying these coins around is really heavy. And geez, on the way, the bandits came and, with their arrows and robbed us. So we took our coins and we put them in a bank. And the bankers gave us pieces of paper, notes, to say, yeah, you have 27, cow coins and 14 chicken coins, and you have a claim on those. And so the whole monetary system evolved from that barter system. And then we discovered electricity, and maybe the greatest invention of all time. And fire's right up there too, but electricity is a pretty good one. And so then we started doing electronic, and now we've got digital, and everybody knows the rest of the story. But that's a long answer to Adam Smith and why the invisible hand. It was really cool. when I was in Scotland, there was a statue of Adam Smith that I actually took a picture of and posted on Twitter.
Really? Very cool.
Yeah.
What's the? I mean,
Cool.
the reason why I wanted to get into this is because I think what you're describing here and that whole philosophy, the Adam Smith pioneered philosophy here, which really like found, I mean, everyone kind of accepted as being true, to your point, is now being slightly challenged, right? And if it's not a full breakdown in globalization writ large, there's kind of this emerging viewpoint that it's going to be something like a multipolar world, right? Where instead of one dominant superpower in the form of the United States, we're going to have maybe the United States over here, kind of the leader of the Western world, and then some sort of alliance, right? Maybe between like a Russia and China over here. And there would be maybe separate supply chains for each one, because honestly, one of the drawbacks of that comparative advantage is if you have a global pandemic and all the masks get made in one place, right? Then there are obvious problems that arise with that, or just medical equipment writ large if it's all manufactured in one place. I feel like we're starting to see that break down a little bit. So the reason I'm, what I want to do is paint the picture here, potentially, if that is the case, a case for more secular inflation, just because there's we talk a lot about almost more like the demand side and money sort of tampering, but on the supply side, that could really be disrupted by this multipolar fracturing that we're seeing. So what I want to understand from you, and one thing that I just have a lot of trouble like parsing out. Okay, so we're seeing this collapse, right? Like all of these charts that we're going to go through. So core PPI in July, core PCE, everything the Fed basically likes to take a look at. We're going through charts here for those of you who are just following via audio, is starting to collapse, right? Maybe they've taken an axe, right, like a chainsaw where a butter knife would have been applicable. It's a very blunt tool. They tried to collapse demand. It looks like it's actually working. The headline CPI print came in below expectation. It was 8.5 handle, where it should have been 8.7 was the expectation, or whatever it was. But my question to you is, do you think we've really tamped down the inflationary impulse? Like, we're starting to see it collapse at the current time, but do you see it like almost a repeat of the 70s type situation where they didn't really fully muster the will to like stamp that inflation out of the economy? Because even though I see this, right, I see these charts, I manage a business, so I can see demand collapsing in real time in the economy. But then there are these other little indicators, right, that it doesn't really, like food, right? Like food inflation is still exploding, right? Like it just seems like everything that I buy on a day-to-day basis, it's practically ticking up by the day. So this is my super long-winded way of saying, do you see this collapse that we're seeing in PPI as something that's a permanent trend, or do you see us kind of whipsawing right in between periods of inflation and then deflation?
As we've talked about before, right? The answers are not the important part of anything. The questions are the important part. And that's why I love doing this is you spend all this time during the week to come up, and then you actually spend time thinking. Very lost art. So lost art. And I don't mean that in the sense that people aren't intelligent. It has nothing to do with intelligence. It's just time and commitment to actually think, right? To meditate, and so I don't mean having to do a mantra meditate, but meditate about an idea, and think about connecting all the dots. And people just are so busy. They're so busy scrolling Instagram. They're so busy picking up the kids. They're so busy working to make a living. We just don't take enough time to really think about the big questions. And that's what I love about doing this show every week is you take the time to think about the big questions, and I can just spew the answers, which are far less important than the question. But the question is important because I will argue, and I have been arguing for a while, that we didn't have anything even remotely close to 70s style inflation, despite the headline number that went to levels, high single digits, or in some cases double digits, low double digits, if you looked at certain components that got people freaked out. But what was being missed was this is a lag effect. What I find just really funny about all of this is there are certain things that are really slow to change, right? And it's because there's a process, right? If the price of an input goes up sharply, then that input has to get harvested, has to get shipped,
Yep.
has to get mixed, has to get produced, has to get transported, has to get put on the shelves, has to get sold, and eventually a new car price goes up if the price of steel goes up or the price of coking coal goes up or whatever. And so that measure, inflation, CPI, PPI, is such a lagging indicator because the event that caused it happened long ago. So if you think back to, the really big evolution in the world, which is this move to digital assets move instantaneously. And everybody says, Bitcoin's not a good inflation hedge. Look, since November, the price collapsed. November has nothing to do with anything. The money supply has actually been going this way. Money supply growth all happened in 2020 and early 2021. Since 2021, mid 2021 to today, we've had a decrease in money supply growth. We actually had negative money supply growth month over month for the first time in almost 40 years. So what's interesting is you create 50% of the dollars. What happens? Well, Bitcoin, if measured in dollars, not one, one Bitcoin is still one Bitcoin, but Bitcoin measured in dollars should have gone up 100%. It did almost exactly and instantaneously, no lag. So now we're all looking at these backward lagging indicators. And for some reason, people are surprised that all of a sudden they're rolling over. Well, look at oil prices. Oil prices 3 months ago were $120. Now they're $90. And I've been talking about this for a long time. By the election, oil prices are going to be closer to $60. Why? Because the number one indicator of whether people like the president and the party is gasoline prices. And the war on gasoline prices, right? We've talked about this. You, Mr. Service station, Mr. Gas station, need to lower gas prices because you're scalping people. What are you talking about? Do you know how gasoline prices actually work? Most of the price is taxes. There's very little profit in gasoline. People who own gas stations don't make money on gasoline. They make money on selling cigarettes and lottery tickets and beer. And I've said this before too. If you walk into a convenience store and you want to put anything in your body, turn around and walk out. There's nothing in a convenience store that's good for you. No. Not one thing. So
to sum up then, basically, are you like, because I think one of the hardest things actually about trying to parse out cause and effect in the real world is a lag, right? Like ideally our simple human brains would like to see immediate cause and effect type relationships. So basically, but that is kind of the question, right? It's like, okay, so we're starting to see a decline in the money supply. That's this direct response, right? This monetary tightening that the Fed is doing. They're raising rates. They're doing QT instead of growing their balance sheet. They're like trying to take that balance sheet back in. I guess my question to you is that sustainable? Because so we had the interview portion of this week. We brought on Jordy Alexander, if you know him, and we're kind of talking about this question about is the Fed actually because there's this idea out there, right? QT, we got to drain the excess money out of the system, right? We got to QT it all back in. And then that's one way that this could go, right? And then there'd be a huge deflation, at least a recession, if not a depression, right? From the pain of withdrawing all the excess liquidity in the system. Or you could take the other approach that actually what's going to happen is what we've been talking about, which is some form of financial repression, which is inflation's kind of going to consistently run hot. It's going to be higher than interest rates. They're going to jack interest rates up, but not as high as inflation. And eventually that debt just gets inflated away. And you get this weird stagflationary environment until hopefully things normalize. The debt normalizes to GDP to a relative level.
Again, genius. So here's the thing. No. I want to hit this point really hard. I did a presentation yesterday. And I do this around the world thing on a monthly basis. And, since it's, Top Gun Maverick season, greatest movie ever, by the way. And I titled it Top Gun JPO. Okay, recession, depression, or soft landing. And JPO promised us a soft landing, right? He was out there a year ago saying, "Don't worry, I got this. We're gonna have a soft landing." I'm like, really? You created the greatest amount of monetary inflation in history, which means you went, and if you've seen the movie Top Gun, Maverick, there's this scene, right, where they're trying to come into this box canyon and drop a bomb on the bottom of this nuclear enrichment site. And then you got to do this steep ascent to get out over the canyon. It's very tense and it's just awesome visuals. But that's kind of what the money supply looked like. It's this parabolic increase. And so what you're telling me is, as you're doing that parabolic increase with, 7, 8 G's crushing your chest, you're about to black out, you're just going to magically, do a soft landing? Maybe. So I will argue that we're in recession, right?
And me too.
2 negative quarters. Oh, that's not the definition. That's not the definition of recession. I understand that, but only one time in history. Okay. Have you had 2 consecutive quarters of negative GDP and not had a recession? That was in the 1947 post-war period where we, jacked up production and made it go away. But every other time. So, and there are 6 indicators. 5 of them are where NBER would have to declare a recession. The only one that's positive is employment, and employment's only positive because of illusion. So if you look at the jobs number that comes out every Thursday, and there's this amazing thing that they do that the BLS, Bureau of Labor and whatever that stands for,
statistics,
Bureau of Labor Security, something like that. Statistics, thank you, Bureau of Labor Statistics. What they do is they can't actually count the number of jobs created because they can't walk around and look at a store and say, okay, you got 5 more employees. And I would argue that they should be able to do it through payroll taxes.
Yeah, I agree with you.
For whatever reason, they do something called the birth-death ratio.
Yeah.
And this is what they do. They literally do this. And you can look it up, and I'm not making this up. They literally say, okay, we are X months into an expansion. Therefore, at X months, this many companies are formed and this many companies die, the birth-death ratio. And based on that, this many jobs are created. I'm like, but okay, one, you're making an assumption that we're in an economic expansion still instead of a recession, because the NBER, lots of acronyms, doesn't declare a recession until 8-9 months later. So to say we're in an expansion is probably wrong. And you say that a number of companies are formed, but again, you don't count the companies. You're just saying based on the past. But right now, people don't have access to credit. Loans, C&I loans are going like this. Monetary velocity is going like this. So anyway, so they're made up. 85%.
Can I actually say, it's so funny that you're bringing this up. We've never talked about the birth-death ratio. I had the episode that's going to come out on Wednesday. It's a sort of debate, sort of discussion between Mike Green and Ben Hunt. And what we were talking about, so Ben wrote this great essay in Epsilon Theory, Hollow Men, Hollow Markets, Hollow World. And it's basically how, increasingly, right, like what is being told to us, right, by politicians, members of financial institutions isn't necessarily right. It's all this like working of the expectations channel, right? It's not saying things because you believe them. It is saying something because you want to elicit an effect. And exactly what they both centered in on was exactly what you're describing, which is the birth-death ratio. So that's a cool little preview, actually. Of it's just funny that you guys are both.
Yeah, and what's amazing? No, it's amazing. And again, and love those guys, and that's gonna be an amazing show. So everyone, put that on your calendar. Watch that show. I will be watching it. And here's the interesting thing: is so the employment looks like it's going like this, but it's just an illusion. And it's just that those aren't real. Like I said, they're hollow men and women, hollow people. And then it's worse than that, because then on top of that, you get this thing that as people turn 65, they're taken out of the labor force. Like, I don't know if you've been to a Walmart lately, but there are a lot of 65-year-olds and older still working because they have to. But they take them out of labor force. And so you get this magic illusion. It is an illusion and magic that it looks like labor's still strong. So I would say all 6 of the things say we're in a recession. But here's the problem. Is it going to be a shallow recession like 2001? 2001, we had first quarter was negative. Second quarter was actually positive. Third quarter was negative, exacerbated by 9/11. Fourth quarter is positive. The whole year we actually grew, but it was a recession. It wasn't deemed a recession until later. The market was really tough that year. Now, what's interesting, and this is, I think this is really interesting back to piloting a plane and trying to make a soft landing, is so if you think about 2001, 2000, we had the tech wreck and the stock started to go down. And then the Fed came in and said, no, we got this. We're going to save everything. And we kind of went like this in the first quarter and got back to even. And then Cisco's like, well, yeah, we kind of lied about earnings for the last 5 years. I mean, there actually wasn't any earnings. And AOL and Time Warner are like, yeah, we kind of made up a bunch of stuff for the merger and we're going to unwind it all. And so, boom, market went down. And then we hit the summer doldrums like this. And there's, everyone's on vacation. There's no volume and there's a big short squeeze. And so the short squeeze, pulls us out of the dive and we're coming back up. And we got almost to even by September of 2001. And then 9/11 happens, earnings collapse, and it's like, bam. And we went straight down into nosedive, and we were down 13% for the year. But then, this is the problem. Then the bad stuff happened, right? Then Enron, WorldCom, and all the fraud got discovered. And I will argue that this time is no different. There's a whole bunch of companies that have been kept alive through fraud and made up numbers, accounting shenanigans, tomfoolery, and another word that Mike Green and others would use. It starts with an F. But it's an interesting dynamic, and so Japo has this really tough job. You think of him in a Maverick helmet and his flight suit. And he's swag. He's got this swagger, and I'm gonna stick the landing. But imagine trying to land a plane on an aircraft carrier. I mean, it's just one of the most amazing feats in all of, I think, modern technological history. So he's got to do that. And I think it's literally like the scene at the end of Top Gun Maverick. Well, I kind of messed up the landing gear, taken off from that bombed out runway, and my tail hook's gone. So I hope you got a big net to catch me because I'm coming down hot and I'm coming down hard. And I will argue that this recession has the potential to become a depression. And that's the question, recession, depression, or does he pull us out of this so we get a soft landing? And that's, Chuck Yeager said, any landing you can walk away from is a good landing. Plane could be totaled, but if I can walk away, it's a good thing. And I guess he did that 5 times where he crashed and still made it. And Chuck was amazing. Talk about a great American hero. So there's a 90-year cycle. And I won't go too deep into this, but there's a 90-year cycle. 1840, there was a depression. There was a recession, policy errors. We went to this free banking system. There was no central bank back then. And so they tried a different approach for political reasons. It's always political reasons that causes the problem. Then 1930, we had, the market crash, and Smoot and Hawley, in their infinite wisdom, no wisdom at all, said, hey, tariffs is what we need to do. We need to stop this globalization, back to this anti-globalization thing. We need to be self-reliant and, in the wake of World War I. And long story short, boom, turned into a depression. Now, 90 years later, here we are in 2022, and we got a recession. We got not just the Fed. Here's the crazy thing, Michael. This is the greatest contraction of liquidity
Mm.
in history on a global basis. You got central banks all over the world. It is the biggest tightening of liquidity, and it's this anti-globalization thing. And the thing about pipelines is if you let them go dry, it's really hard to restart.
Yeah.
You know, if you stop the momentum of something good, it's really hard to restart it like a flywheel. And so I think we are dangerously close to a whole bunch of stuff. And again, it doesn't have to happen that way, but I'm concerned about it.
I think it's always tough to, like, looking at history is helpful, right? It's the best thing that we have to predict the future, or at least to avoid some of the same mistakes. But I would say maybe one of the differences between now and where we've been in the past is actually the degree of, let's call it whatever, loose money or financial manipulation or whatever is it that's in the system is actually so high that I think people are genuinely scared. I think policymakers understand and are deathly afraid of what happens when they withdraw and stop manipulating to the degree that they have been. Because to your point, it would cause something that's pretty like when Volcker, we talked about why the 1970s might be a bit of a flawed analogy, because if we can't raise rates to 18%. I mean, even the most wild hawks out there, right? Nobody's even talking about like 6% rates, right? So it's just, I think it's just different. I want to get though to an important story because we've got some interesting things going on in crypto land, and maybe the most interesting way to bridge what we're talking about, right? Especially with some of these. Well, I don't want necessarily didn't like that. I want to talk about Coinbase earnings because Coinbase earnings came out this week. Yeah. I know you guys are an investor in the stock. I'm not sure if I've announced this publicly. I top ticked Coinbase. I bought like the IPO, and I've aggressively top ticked the stock. But I'm still a big fan of the company. But I do think it's interesting to go through earnings and pick out a couple of things, right? Coinbase, they announced a big loss on their earnings. So it's like over $1 billion of net income loss, which no one was particularly surprised about, right? They had an adjusted EBITDA figure, which I want to talk to you about because there's something very interesting going on there with stock-based compensation, which I think is a broader, more important point that we should be talking about because that's finally starting
broader issue
that's starting to matter again. And then I also want to talk about like the composition of Coinbase's revenue. I actually want to ask you a question because I've been looking into this and for the life of me, I can't figure out what it actually is. But, the breakdown of these exchanges. So Coinbase's, they did some $800 million in revenue this past quarter, right? 650 million of that was transaction based. 150 million of that was it was their services, their kind of subscription services type stuff, which is largely, I think, staking based revenue. The transition for Coinbase is they want to move from a transaction-based model where like 616 of the 650 million is from retail, which is not sustainable, I think, in the long run. So they got to find a way to bridge that gap, right? I know Brian Armstrong is probably internally being like, guys, I know we've made a lot of money doing this. We got to, charge for it. We got to move into, providing access to these other services within crypto. But I'm curious to get like your breakdown of how you see them making that transition. Like, when you look at Coinbase, do you still view them as a largely an exchange where they're semi-successfully trying out the subscription model, or like how do you view their revenue breakdown, and what is that line item on the it's like 150 million of, is it staking revenue? I've been trying to figure out what it actually is.
Yeah, I think you're right. I think that's what it is, and there's some fee-based services that they have a custody business. They have a big institutional custody business that we use because they bought Zappo, right? And it's kind of like the Fort Knox, not Fort Knox. It's more like a Swiss bank, vault with cameras and armed guards and the old fashioned. If you're gonna have this asset, think about gold, right? Gold is these bars, and you don't want it to be stolen, so you put them in a vault and you concrete walls and combination locks, and then you got guards, and it's pretty expensive. And so if you go back to the early days when Wences Casares was talking about this, and he's talking to all his friends, like, okay, do this, and they did, and people made a bunch of money. And like, well, what do we do with it now? It's a bearer asset. I don't want it in my house because someone comes to my house. So they put it in this vault, and Coinbase has that. So that's a thing that can develop, and you just charge me a fee for custody. And it's kind of like the difference between retail banking. In the old days of retail banking, it was very transactional, and you charged people for everything. And then Wells Fargo figured out a way to turn it into more of a fee for service model. And who then bought it? Warren Buffett, because he likes fee for service businesses that he can lever up. And I think the same thing's true here. Is if you think about an exchange, look, really important. And we've had an explosion of exchanges globally. Some of the best investments right now are in these other emerging and developing countries where people are just coming to the business. And you got one in Indonesia that's going crazy, and I mean in a good way. You got some in Eastern Europe, the Middle East, and so exchanges go like this, like the banking industry did, and then it'll consolidate, and there'll be a small number at the top. And I don't, I know the Wall Street wants to hear, we're moving away from retail, and what's wrong with retail, right? Retail is really, really important. And okay, we don't want to be a shitcoin casino, fine. But people are going to trade stuff. And is the stock market any different than a shitcoin casino? The vast majority of stocks are micro caps and just punting back and forth. Most people don't think, I want to trade IBM. I want to trade it back and forth. Oh, they don't want to trade. They want to trade some little biotech company or some little fintech company. Nothing wrong with that. That's how speculative behavior happens, and it's what makes markets. So I think that functions perfectly fine. You get a higher multiple for fee-based revenue than transactional revenue. It's always been the case. It's like this migration to cloud. Right? You take a software business that used to charge for boxes, and then you say, oh, you're going to pay us 3 years in advance of what we used to pay every year, like a Norton. And instead of getting a 6 times multiple, now we're going to get a 26 times multiple. Like it's the same amount of revenue, but for whatever reason, we pay a higher multiple for it. So that game has been going on forever. So I do think the communication of, no, we're going to move to a more, fee-based system. And I think you need to innovate, right? Coinbase was first as a big exchange. I think they do need to innovate. They need to get the NFT platform up and vibrant. And, at last time I checked, they had 6 million people on the waiting list. I'm one of them, and I'm still waiting. But I think that came closer to reality. Maybe I just haven't been paying attention. So that's a long answer to say, look, I think the challenge for Coinbase is they are in a position that they threaten the hegemony, right? The reason that Brian got in a little pissing match with the head of the SEC was, we've talked about this, right? We're in the then they fight you stage. We are deep in it, and it's going to get worse. So we're going to talk about that. We're in the then they fight you stage. 2009 to 15, first they ignore you. Nerds, geeks, go play with your magic internet money, whatever. 16 to 21, then they laugh at you. Are you serious? This is not real. This is just stupid. Okay. Ha ha ha. You guys are idiots. Now you're talking multi-billion-dollar companies. You're talking huge swaths of the population being involved and engaged. And it's like, oh, wait a minute. This is real. This is an evolution of computing power. This is better money. This is a whole better way of doing commerce. Geez, I better get worried. So now the big boys, the BlackRocks and the Citadels and everybody else is like, I need to get involved. And that's why we're seeing announcement after announcement. And so Coinbase is in a tough spot in that they were first, they were best, and everyone's now coming at them. And just like you think about the big banks, once they got big, then what happened is the fintech guys came and chipped away at them and tried to take little pieces of their business. The problem with fintech, right? We've said this before. There's no tech, right? We're still using Fedwire, ACH, 60, 70-year-old technology, not very good. And now what we have the chance to do is build real new payment rails, new commerce rails. And that's all very, very exciting. But for me, I think Coinbase is going to struggle as the one being under attack regulatorily, competition-wise. Although I did think it was very interesting that BlackRock said, if you can't beat them, join them. And they didn't join them completely. But they said, we're going to work together.
And BlackRock is rolling out its own solution, which we'll talk about in a bit, which is honestly, and I got, again, Zahir, our guest on the Roundup last week, gave you credit on Twitter. If you've been listening to the Roundup, right, the playbook is first you fight them, then you lobby against it. You say, hey, this isn't good, blah, blah, blah. You try to beat the price, and then you launch your own solution. And that's literally exactly what BlackRock has done. But before we get there, I do want to get your take just on the stock-based compensation. Yep. So to share some raw numbers with you here. So the reason why stock-based compensation is important and how this filters down to a balance sheet, right, is stock-based compensation is, right, instead of saying, hey, maybe you get $100,000 a year for your job, take $80,000 in cash and another 20 in our stock, right? That's good if the stock goes up, not so good if the stock goes down. Importantly, that's a non-cash expense, right? So when a company has to pay you, right, there's actual dollars that have to flow out of a bank account, but give you stock, non-cash expense, right? So overall, what that has the effect of doing is juicing your free cash flow, right? Like that's the most important thing. That's the way that I see it, right? Giving stock-based compensation,
Absolutely.
Right? So if you want to reduce your burn, or if you want to show a more positive free cash flow, then maybe is like actually reflected, right? You do stock-based compensation. So the reason I'm bringing this up, and this is where I want to actually, I actually see both sides of this issue here. So Coinbase's stock-based compensation on 800 some odd $1 million of revenue was 391 million. That's almost 50%. That's very high, right? So you can actually see the EBITDA that they reported is actually adjusted EBITDA, and the adjustment is not including stock-based compensation. So that's a little bit of this, just something to point out. Right. But that being said, I have
tech companies have been doing this for years. Tech companies have been doing this for years. Amazon, Facebook, Microsoft. It is it's accounting shenanigans. It's the bezel. It's John Kenneth Galbraith talked about this. Is the accountants will come up with ways to fool the system against reality, and the top will steal. That's the bezel, embezzlement, from the masses until they're found out, and then regulations will come in, tighten it down, and then you'll start over. And stock-based compensation, carried interest, taxation, all of these things are out there that could become a problem for companies. But guess what? Every time the regulators go after it,
magically, oh my God,
the last second, it gets taken out.
I was going to tell, I was going to talk to you about this, but yeah, carried interest, almost the loophole almost got closed. And for those listening, and Mark, you know this so much better than I do, but just to give you guys right, if you're a GP at a fund, you get paid in two different ways. You've got your management fee and then your performance fee, right? So like, let's say I raise $100 million worth of other people's money. Maybe I get 2% of that, right? To like cover my expenses and operating costs. That's $2 million. But then let's say I invest that $100 million, I get 20% of that. So I earn $20 million from my investors. 80% of that goes back, to my investors, but I keep 20% of it for myself. That's what I get. Now, the way that gets taxed is not at ordinary income tax, right? So you're making that, usually GPs and hedge funds, private equity funds, right? They're making the big bucks, right? They should get taxed at the highest tax bracket. But what they say is actually that's a poor alignment of incentives, right? I should be incentivized, right? I should be thinking long-term, yada, yada. So they actually get taxed at long-term cap gains tax instead of ordinary income tax, which is, 20%.
Well, so you and I may differ on this. Is that's the way it should be, right? It is capital at risk. It is an investment, and look, capital gains tax rate should be zero. There should be no tax on capital gains, right? Taxing income creation and wealth creation, stupid.
Oh yeah, right? Tax consumption.
Just stupid. It's always been stupid. Yeah, I mean, look, the idea carried interest came from ancient times, right? Corinth, right? This little town on the little isthmus of the Greek peninsula, and the ships would go down around the peninsula and they'd crash. They're like, we don't want to crash, so they built a train track across the 7 miles of the isthmus, and you'd pull into Corinth, and you would put your ship on the track, and they would carry it. Literally, slaves would carry it, pull it on the track across, and they would take 20% of the carried interest. And that went on for years. And then when Queen Isabella sent, Christopher with his ships, she said, all the gold, 80% of it's yours, 20% is mine, that carried interest. And when you put capital at risk, right? She put capital at risk. Those ships could have got down. Most ships did go down. You lose it. And so if you think about management fee, I get regardless of what happens. Markets go up, markets go down, I still get my management fee. That should be taxed at the highest rate. It's ordinary income. Now, it shouldn't be taxed at ordinary income. You should tax my consumption, not my income. But that aside, the money we put to work, it could go down, and then there is no incentive fee. If it goes up and we make money for our investors, that is a gain. And so there are a lot of people who differ on this, but in the end, that loop, you call it a loophole, that will never go away, because the amount of money that goes into lobbying is insane in this regard, right? So people will talk about it and they'll complain about it, and Liz Warren will rail against it. But look who Liz Warren gets paid by, and you have a different view. And ultimately, it's look, the graft and corruption in DC is frightening. It's not just DC. Look, your own state, right? In New York, the governor, $300,000. That's not even a lot of money. Again, it's a lot of money to most the average person, but it's not millions and millions of dollars. This family gives her $300,000, and using an emergency use authorization, she gives them a $600 million contract for COVID tests. Are you kidding me? No bid, no contract, no open, competition. That's wrong. That's actually a felony in my mind. That she should be in jail. Crazy.
Here, I'm going to propose something that a million people have thought of, but I'm just thinking of it. You know how, like the FDA, right? When you sell food in a store, you have to say, "Hey, this is what the caloric intake looks like," right? Here are the different ingredients in it. You have to say that. These politicians should have to wear a goddamn jersey and say, "These are my top 5 donors." They should just have to wear it. Like they should have to.
Love
and so
it.
like NASCAR. So you could
like
just
NASCAR.
Physically look at
That'd
it.
be awesome.
Even just the top 5. Just the top 5. And it should honestly be there visibly. Because Mark,
I love it. No,
there's such a okay, right? Let's say of all the politicians that are out there, even this, I don't know how public this information is. I should look into this. But let's say nobody knows, right? Like the 2% of people even know who is paying who. But there's a huge difference between just knowing where the money is coming from and physically having to see it. Imagine like Elizabeth Warren getting up there, right? And I'm not picking on Liz Warren here. Take any Republican, right, too. Just imagine a politician getting up railing against, crypto with like JP Morgan as their number one donor. You're like, wait a second.
Absolutely. Or how about this? How about anyone getting up to say, you must take this vaccine with a giant Pfizer badge on their
Yeah.
chest.
I think we're making dangerously good sense here, Mark. I think we're making dangerously good sense. Yeah.
I love dangerously good sense.
Yeah.
DGS.
But I want to briefly return to the stock-based compensation. Then I want to, because the important, and the reason why I actually want to defend, well, here, I'll say something that's maybe not super friendly to Coinbase, and then I want to defend them to give both sides of the argument here. So basically, Coinbase's EBITDA, right? Like they would have to be paying more, right? People are basically assigning a burn rate to the company. Like it's probably worse actually than it looks in the numbers, especially when honestly SBF did this tweet and not a lot of people picked up on it, and he's doing his own psyops thing, right? He's not friendly to Coinbase, right? He wants people to pick up on this, but the transaction cost that he outlined, that was probably, there's a question mark about how profitable really the subscription part is on Coinbase. So basically their stock-based compensation to their employee ratio is very high. However, here's how I'll defend them. I understand why that is, because it was impossible to hire in crypto for the last 12 months because every little random shitcoin that raised money created $300 million out of thin air, which was actually worth nothing in most cases. We're doling out $5 million to anyone who would join. And if you were an actual company that was trying to build in this industry, it was just so difficult to hire. And that's what Coinbase was going up against. They were going up against people, people saying, hey, I'm getting paid $5 million by random, decks on, an nth level, like third tier layer one. And, you can say that isn't real money until the cows come home, but people don't listen in those situations. And if I was an employee being offered that, I wouldn't either.
No. Look, in the bubble, nobody listens. Yeah. In the bull market, everyone's a genius. And look, we are in a really interesting time. And, at the end of the day, $800 million of revenue in a quarter.
I think it is too.
Awesome. There are not very many companies. There are not very many companies in the world. There aren't that many companies in the world. They're not zero, but there aren't that many that can earn $800 million in a quarter. And I'll make up a stat on the spot, right? 85% of statistics are made up on the spot. So I will follow that. That I'm going to guess, if you looked at the revenues of the S&P 500, some large number, 420, 450, I don't know, of the companies don't make that much in a year, let alone a quarter.
No. I'm with you. And the other thing about Coinbase that I want to defend on them too is like there are all these people in this industry who are like these, centralized companies, blah, blah, blah. It's like, guys, but they're also leading the front, advocating for us on the regulatory stage, right? Which is something that largely happens behind closed doors and isn't public. And they're like a lot is riding on Coinbase now. So if you're sitting there, saying,
and they've spent more money on security, they've spent more money on safety, they've spent more money on education. They provide a service to help the masses, the people who don't have time and inclination to really understand how you manage a bearer asset yet. They will eventually. And eventually there'll be a wallet system that's good enough and safe enough. But right now there's not. And for the same reason that banks exist, like theoretically, right? We could all keep our money in our house.
I don't want to do that. Why would we want to live in that world? I don't want to live in a world where I have to have a shotgun.
No, exactly. Why would we want to live in that world? Exactly.
And
exactly.
Sorry.
Exactly. And there's a reason that these types of businesses exist. And look, when you're at the top of your game, the haters are going to hate. So the haters are going to hate on Brian. The haters are going to hate on Coinbase. But at the end of the day, they started with nothing but an idea, and they executed, and they built a great business.
Started from the bottom.
Yeah.
All right, I've got to shoot. I've got so much that I want to work through here, and I'm just remembering. But okay, here's the one thing that I want to outline to you, and I think it's an important point because it's a realization that I'm coming to. So these Treasury sanctions against Tornado Cash are an enormous deal, right? And as the Treasury sanctioned Tornado Cash, and there's breaking news this morning, so we're recording this on Friday, like we always do. It's 9:06 a.m. current time. Blockworks just reported that the authorities have arrested a 29-year-old in Amsterdam suspected of being a developer for Tornado Cash. But Circle, USDC, again, in another very difficult position, is sanctioning smart contract addresses. Now, the reason why this is important is because unlike in the way enforcement works in the banking system is there's KYC, right? So basically the onus is on the bank to enforce KYC and know who they're dealing with. So regulators can go to banks and then banks can enforce to individual people. What is interesting, what is really challenging about the current way that the Treasury is trying to outline their sanctions is they're putting the onus on individual people. Because there are no intermediaries, they're sanctioning individual smart contract addresses, which makes it very difficult because someone can just send you tainted, USD tainted ETH or something like that. And suddenly your address, right, that received that can just get frozen. And what makes that really challenging in the case of Circle and USDC is that USDC is the collateral for an enormous amount of DeFi, including more decentralized stablecoins like DAI, right? Maker DAI, right, is largely collateralized by USDC. And there's one smart contract, the PSM, which control is the mint function, right, for maintaining the peg. So basically if you sent tainted assets into that smart contract, it could jeopardize the entire existence of Maker. So Rune, the co-founder of Maker in Discord yesterday, is like, hey, I think we should we should move away from USDC into ETH, even at the risk of losing the peg on DAI. Now, to me, I understand the existential risk. I just don't think that's worth it because if you don't have a peg, you don't have a product, right? The whole product is maintaining the peg. So you're kind of saying to avoid this risk in the product, let us destroy the product, and then there will be no risk. So I don't agree with that, but man, it is a tricky dilemma for DeFi right now. I don't know.
Look, we've talked about this, and this is, and the sad part is this is the beginning. This is not the end. This is the beginning of the then they fight you stage, and the banks, right? Those NASCAR sponsors of politicians really don't want to lose, right? They really like the fact that my money, much of it, sits at this Bank of America place, and it's their money now. And they would really like it if I didn't take it and convert it into Bitcoin and other things, which I've done over the years. I've told the story that first time I tried to buy Bitcoin, actually at Coinbase, not even directly, it froze my money for 14 days. What do you mean? Well, look at your contract. That's what it says we can do. I know you can, but why? Well, because we don't want you transferring that. That's a money that we like. And so this whole idea of, what do they say? 70% of dollars have traces of cocaine on them. So is that dollar disqualified? If it's got cocaine on it, it's been in illicit activity, and therefore, you shouldn't be able to use it. Well, obviously you can't do that because you can't tell if a dollar has been where. But if it's in a bank account, you can freeze that bank account. That's what sanctions are. If it's in a smart contract, you can freeze it now. And so this idea that 1 part per billion, right? If one fraction of a Bitcoin went through an account linked to Al Qaeda, that Bitcoin is now.
I agree.
That's just ridiculous. Absolutely ridiculous. It's insane. But they in air quotes, get to make the rules. And he who has the gold makes the rules, or they who have the gold makes the rules, men and women. And they are going to fight, and they're going to do this stuff. And I'm with you. I think burning something down to save it, wrong answer. We got to fight, and we got to fight. And unfortunately, who's going to get rich? The lawyers again.
Yeah, they always do, man. I I don't know who. If you're a lawyer,
They
I
always
honestly,
do.
my heart goes out to you. I thought I was going to be a lawyer for most of my life as a classic psych double major. So I have a lot of empathy, but I also have tried to. I've
I'm
tried to
nothing
get a straight
against
answer from a
lawyers.
lawyer. Oh my God, man. It is like trying to draw blood from the stone. It's like, please just tell me. Please, for the love of God, just tell me.
Straight answers don't make money. No, straight answers don't make money because straight answers don't lead to further questions. You need to give answers that prompt more questions because questions are valuable. Every time you ask a question, they get to charge you. And so you can't, well, it could be this, or it could be this, or it could be this. Which one do you want? Oh, B, pick B. Okay, now, but B, it could be B1, B2, B3. So which one do you want? B2. Oh, well, B2 could be B2 little a. And look, transactional business is awesome. Like one of my favorite jokes, so two good lawyer jokes, right? One, what's 40 lawyers in the bottom of the ocean? Good start. Ha, ha, ha. But my favorite one is, the guys at the pearly gates. And he says, St. Peter, there must be something wrong. I'm only 50 years old. I can't be here yet. And he says, no, according to your timesheets, you're 100. So, I've
That's funny.
experienced that.
I thought you were, you gave me a little bit of nostalgia there. My grandpa, like every joke he told me when I was a kid was an interaction between St. Peter and someone at the pearly gates. You just gave me a little bit of great nostalgia there. All right. All right. So we've got to wrap it here because we're out of time, but I've got a bit of homework for people. No. Actually, well, I got 2 bits of homework. First, click the link at the bottom, Mike250, use that code, please, for the love of God. But second, go look up something called Why Most Published Research Findings Are False. Look that up. I went down this rabbit hole. This was inspired by a guy named Zuko Wilcox. He did a recent interview on Up Only, and I listened. And just look that up. All right, that's going to plant a seed for something, Mark, that you and I are going to cover in next week's episode. I was blown away by this. So look it up. Why most published research findings are false. Mark, best hour of my week, my friend. I will see you here same time next week. Cheers.
Awesome.